Conservatism is an accounting principle that really touches a lot of the subjects that we do throughout the year. So we're going to have a look at a few different examples for conservatism because it does impact so many little other topics, the way we record things. It's all reflected in conservatism. So what does it mean? Well, it's kind of got a two-part definition. First of all, it's all about applying caution, and that means two things. One, we record losses when they're expected, but we only record gains once certain. What does that mean? Once they've actually been earned or received. So the second part of the definition is, well, why are we doing that? We're doing this so assets and revenues are not overstated or too high, and liabilities and expenses are not understated or too low. So it's really important when you're doing conservatism, when you're relating it, you're putting in this part here. So what do we mean by that? We'll look at some examples. Let's say a business is valuing its inventory at the end of December, which is the middle of summer. The owner has 1,000 raincoats in stock, and they cost $80 each. Given it's now summer, and by the time next winter comes around, the coats will be out of fashion, the owners decided to write the coats down from their cost of $80 to their net realizable value of $50. Explain whether the owner was correct in making this decision. So I've identified my theory, which is conservatism. I've defined it, and I'm only going to give the part that's appropriate. So I'm only going to say caution should be applied when preparing reports to ensure that losses are recognized when expected. I only talked about losses. That's what's happened here. I've got coats that were 80 down to 50. There is no gain. So if I give gain or start mentioning gains in my answer, I'm actually going to lose mark. It's what's called an alien entry. You're just rote learning an answer that's got nothing to do with the question, and the examiner's made comments in recent years specifically saying you'll lose marks for that. What I haven't done is related it to this question and said, well, what's that got to do with these coats that cost $80 but can now only be sold for $50? So in this case, I'm going to say the owner's made the correct decision. By writing the coats down to their net realizable value, the owner is recognizing an expected loss. Still probably not enough detail here. Why do we do it? We do it for two reasons. One, so the assets are not overstated, and the asset in this case would be stock control. And two, expenses, in this case stock write-down, are not understated. Example 2. The owner has given the business a computer. When bought 2 years ago, the owner paid $2,300. The estimated agreed value is now $1,500. Explain the amount at which the computer should be valued in the firm's balance sheet. I've identified and defined conservatism. What I'm talking about now is a loss. It's lost value, in this case from $2,300 to $1,500. Obviously this is related to the entity principle as well, so I'm just answering this from a conservatism standpoint. If you want to answer it from an entity standpoint, go and watch the video we did on the entity principle. In this case, I'm going to relate it and say the computer should be valued at the agreed value of $1,500, which is the lower amount. This will ensure that our assets are not overstated, in this case computers. Example 3. A business which owns a property in Melbourne CBD is taking out a new insurance policy. The insurance company has said that the property, which was bought in 2004 for $1.2 million, now has a market value of $1.8 million and must be insured for this amount. The owner is now debating whether to revalue the property in the firm's balance sheet to $1.8 million. Explain the amount at which the computer should be valued in the firm's balance sheet. So the balance sheet is different to insurance. Insurance is just whatever you get charged by your insurance company. So according to the insurance company, this property is worth $1.8 million. We only paid $1.2 million, so we've made haven't made, but we seem to, on paper at least, have made some sort of gain here. However, how should I value it? Should I value it at the new figure or keep it at the cost of $1.2 million? I'm going to apply caution, and this time I'm going to give the part of the definition which refers to gains. If I mention losses here, I'm not going to get a mark and I'm going to lose a mark. This has nothing to do with losses. So I'm only going to recognize a gain when certain. Well, a gain with property would only be certain when I sold the property. Seeing as I haven't sold it, I'm not going to recognize this gain. What does that mean? In this case, I'm going to keep the property valued at $1.2 million. This is because the 1.8 is an estimate. It's actually not certain to occur. There could be a property market crash. And the reason I'm doing this is to ensure that my assets called property are not overstated, but also I'm making sure my revenues of $600,000 gain are not overstated as well. Last example, the owner of a business has just purchased a delivery van, is debating whether to depreciate it using either the straight line or the reducing balance method. The firm's accountant has provided the following graph showing estimates of the depreciation expense over the van's useful life. So with straight line, it'll be $11,000 every year. With reducing balance, we can see it'll be more at the beginning, so it'll be $9,000 more, but at the end, it'll be quite a bit less. So what question have we been asked? We've been asked, explain which depreciation should be used this year, so in the first year. So just going back, in the first year, reducing balance will charge 20, straight line will charge 11. Based on that and applying conservatism, I'm going to identify that we should use caution. There's not real gains or losses here, so I don't really need to mention that part. This is just about caution. What I'm going to say though is I'm going to use depreciation in the form of the reducing balance method, and the reason why is that'll charge more depreciation in year one, and what that'll do is make sure my assets are not overstated. The carrying value will be lower if I use reducing balance, and secondly, expenses are not understated, in this case depreciation.